Hi, my name is Denver Noes with Wealth for Life. Today we're going to talk about tax diversification and why it's so important when it comes to your retirement income. Now, when you're looking at tax diversification, there's three basic ways that assets are held with regard to taxes. The first is going to be what's called your qualified bucket. Qualified bucket is going to be the things like your 401ks, your IRAs, your SEP plans, your defined benefit plans, all those things that give you a tax deduction now, but their taxes already in ordinary income down the road. When you take the money out, the taxes are deferred until later. The next area, of course, is going to be the capital bucket. Those are going to be things like capital gains. That's the the pay-as-you-go system. You're going to have things in there like real estate. Traditionally, of course, that's stocks, mutual funds. Those things are going to fall into that capital gains tax area. And then the third area, which is we're going to talk about, is the tax-free area. Tax-free, of course, is nice. People like tax-free. That's going to include things like the Roth IRA, Roth 401k you would also put into that category. Muni bonds would also fall into that. And then life insurance, particularly permanent life insurance, is going to fall into that area. And so when I talk to people, I generally ask, well, how is your assets typically allocated right now from this tax diversification standpoint? Most of the time I'm going to hear an answer like, well, we're about 80% in the tax deferred. Usually it's going to be 401ks, defined benefit plans, and then we're maybe about 20% in this capital gain area, and then unfortunately we don't have a lot in this tax-free area. So then the problem is, well, what happens if taxes go up in the future? And if you ask a lot of people with where we're at as a country and things like that, do you think taxes are going to be higher or lower in the future? Most people would say, well, I think taxes are probably going to be a little bit higher. Well, what happens if you're pulling all your income out of a qualified plan like a 401k and taxes go up? Well, pretty simply, your income goes down. Same thing happens in a capital gains situation. If you're pulling all your income out and you're getting taxed capital gains taxes go up, your income goes down. So that's why you want to have some diversification and have some money that's insulated from future tax increases, having money in that tax-free bucket as well. So instead of kind of going all in on this taxable side, it's better to come up with more of a balanced approach and kind of be saving into, certainly in tax deferred, taking advantage of some of the tax savings now and the matchings and 401ks and things like that. Having some money in these other income streams, it's going to be taxed at capital gains, but then moving to where you have some money in this tax-free position. So that way when you get down to retirement, if taxes are high, you pull from your tax-free bucket, or if they go up. If taxes are lower, you can pull money out of the taxable side. Now it takes some time, to get, to this type of diversification. The sooner you start putting money in a tax-free position, the better. But, so it might be 60-40, it might be 70-30, on taxable versus tax-free. But the important thing is to start looking at your assets from that standpoint, because if you don't, it can really affect your income down the road if taxes do go up. So if you like this information, you want us to get an analysis, we can even look at your assets and see how you're allocated. We have some simple calculators that can do it and even estimate some of the future tax liabilities. Shoot me an email, denver@wealthforlife.net, or give us a call at the office, 480-970-5663 is the number, and let us know if you have any questions.